Welcome to this explainer. I am absolutely thrilled you're here with me today. If you're focused on truly understanding the deep mechanics of modern business, well, you are definitely in the right place. Today, we're taking on a topic that is constantly in the headlines, but honestly, it's pretty often misunderstood. We're moving way beyond the buzzword of ESG. Have you ever wondered what risks might be lurking right beneath the surface of a company's balance sheet? You know, things that traditional financial ratios completely miss? Well, today we're going to use what I like to call a modern financial X-ray to uncover those hidden risks and opportunities. Here's our quick roadmap for today. First, decoding the ESG framework. Second, breaking down E, S, and G. Third, unearthing hidden equity risks. And finally, investing with purpose through bonds.
Okay, let's dive right into Section 1, decoding the ESG framework, moving from a buzzword to an X-ray.
Let's get crystal clear on our definition right out of the gate here. ESG is a standardized framework used by corporate managers, investors, and financial analysts to evaluate a company's management of non-financial risks and opportunities. Notice those words? Standardized and risks. This isn't just about feeling good or some PR stunt, right? Modern corporate finance treats ESG strictly as a rigorous, absolutely core driver of long-term value creation, operational efficiency, and capital protection. It's really about seeing the whole picture.
Now, ESG actually operates on two entirely different levels, kind of like zooming in and out on a map. On a macro level, we have country level, or sovereign ESG. This looks at the big picture, a nation's vulnerability to climate shocks, its income inequality, or its institutional strength. For example, if a country has poor governance with high political instability, international capital literally flees, the sovereign credit rating drops, and the cost of capital spikes for the entire nation. But on the micro level, we have firm level, or corporate ESG. This zooms in strictly on how an individual corporation manages its operational sustainability, stakeholder relationships, and internal behavior within its specific industry. For the rest of our explainer today, we're going to focus entirely on this firm-level view.
Moving right along to Section 2, breaking down E, S, and G, the three pillars.
Let's kick things off with the E, environmental. Companies face massive physical and financial risks if they just ignore the environment. Failing to manage these risks leads to huge tangible costs. Think of the financial nightmare of cleaning up an oil spill, facing massive reputational damage from a pollution incident, or dealing with heavy litigation. That's exactly why this global target is so absolutely critical, achieving net zero emissions by 2050. Basically, this means removing all man-made greenhouse gases from the atmosphere through reduction measures, balancing out what we put in. It's a fundamental shift in how businesses simply must operate to survive the coming decades.
Now, what about the S? Let's see how this builds into the social sphere. The social pillar measures a company's direct human impact. It expresses social trends and conditions impacting human well-being. We're talking about the quality of life for employees, customer data privacy, which, let's face it, is incredibly vital in our digital age, human rights, and labor standards deep within the supply chain. If a company has high accident rates or a history of poor data protection, that's a major red flag. It tells investors that the company is mismanaging its human capital and customer trust, which are critical, undeniable assets.
And finally, the G, governance. So the crucial point here is defining what good corporate governance actually looks like in practice. It rests on these four pillars: the board of directors, management, internal auditors, and external auditors. Good governance mitigates risk by ensuring things like board independence, fair executive compensation, and strict anti-bribery and corruption standards. When a company is well-governed, it doesn't just benefit the shareholders, it benefits employees, customers, and suppliers alike. It's the sturdy foundation that keeps the whole corporate house standing, you know?
All right, on to Section 3, unearthing hidden equity risks, the financial X-ray in action.
It's time to put our financial X-ray to the test in the real-world equity markets. Risk management is the absolute essence of investment management, and ESG data gives us that crucial new perspective to unearth vulnerabilities hidden deep inside the balance sheets. But before we dive into the raw data, I want you to ask yourself a question and just play along with this hypothetical for a second. If you were building a long-term portfolio aimed at really protecting your capital, which type of business would you prefer to invest in?
Let's look at a pretty stark visual contrast here. On one hand, we have Microsoft, right? A blue-chip software and services giant. On the other hand, Las Vegas Sands, a massive player in the casinos and gaming industry. Traditional financial metrics and quarterly earnings might show both of these as highly profitable enterprises, but What happens when we apply our ESG X-ray to these two completely different business models?
Now, what's really interesting about this slide is the story the data tells us. Notice Microsoft's total ESG risk score, 13.6. That's categorized as negligible risk. They've highly managed their environmental footprint and governance. Now compare that to Las Vegas Sands, coming in with a score of 20.6, which is categorized as medium risk. Notice specifically the governance risk score difference. Microsoft is at 4.4, while Las Vegas Sands it's almost exactly double that at 8.1. If you're an institutional investor looking to protect billions in capital over the next 20 years, these numbers are just as important as revenue growth. They reveal structural operational vulnerabilities the traditional accounting completely misses.
Let's wrap up with Section 4, Investing with Purpose Through Bonds.
We're moving from the equity side over to fixed income instruments. While ESG feels like a very modern, trendy conversation, green bond issuance actually began way back in 2007 with the European Investment Bank and the World Bank. To ground this abstract financial concept in reality today, let's look at something you might literally be holding in the palm of your hand right now. Apple issues green bonds to fund explicit environmentally friendly projects. Specifically, they use the proceeds of these bonds to purchase the world's first commercial purity, low-carbon aluminum from a company called Elysis for the iPhone SE. This isn't just a corporate pledge on some website, it's a fixed-income financial instrument physically altering the manufacturing process to support clean tech. No way, right? Let's walk through these 3 steps, because this brilliantly illustrates the tripartite benefits of green bonds. It's a powerful alignment of interests. Step 1. For Apple, issuing these bonds demonstrates environmental leadership, enhances their brand reputation, and aligns their financial strategies seamlessly with their 2030 carbon neutrality goal. Step 2. For investors, it provides a highly transparent ESG fixed income opportunity. You know exactly what physical projects your money is building. And Step 3. For the environment, this directed funding accelerates innovation in green technologies and low-carbon materials, actively reducing global carbon emissions. It's a win-win-win.
But hey, we can't forget the S in ESG. Let's introduce social bonds next. Citi provides a prime example here with their social bond framework specifically targeting affordable housing. Affordable housing is broadly defined as housing where occupants pay no more than 30% of their income for gross housing costs. This specific Citi bond generates capital strictly for that vital purpose.
Notice the targeted use of proceeds detailed in this table. It finances the construction and preservation of affordable housing primarily for low and moderate income populations, and that includes veterans, people with disabilities, and those experiencing homelessness. What's super notable here is how this maps directly to UN Sustainable Development Goal 11, which aims to make cities inclusive, safe, resilient, and sustainable. When an investor buys this bond, they are injecting capital directly into solving a specific, measurable societal challenge while still earning a fixed return.
We have covered a wealth of information today, from redefining the E, S, and G, to comparing corporate risk scores, to seeing how financial instruments like bonds can literally build a better world. By understanding this standardized framework, you're now equipped to look past traditional balance sheets and uncover the whole story. So I'll leave you with this final, provocative thought to consider. Armed with this financial X-ray, how will you measure the true value of your investments moving forward? The risks and opportunities are there, hiding in plain sight, just waiting for those who know how to look. Thank you so much for joining me on this explainer. Keep learning, keep questioning, and I'll catch you next time.